Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're going to be doing a little bit of math. That's right. The real purpose of today's show is to talk about the importance of financial education. Some people, notably lawyers, mathematicians, accountants, engineers, and statisticians, are going to find this math pretty simple. But for the general population, the inability to perform basic financial math is one of the reasons that Wall Street and the major insurance companies are able to exploit their customers and, quite frankly, give them a bad deal on their money. And on today's show, we're going to look at what some life insurance companies are quoting for income annuities. These financial instruments are often used by people later in life to guarantee an income stream in their later years. Some of you might be wondering what an income annuity is. Quite simply, an annuity involves paying a fixed lump sum of money into an insurance company at the beginning. Then the insurance company in turn guarantees you a regular monthly income for the term of the annuity. There's a couple of different types of annuities. Some are somewhat like an insurance policy in the sense that the insurance company takes the risk on how long you're going to live. You might purchase an annuity that has a 10-year minimum on it. That means that if you die after 8 years, the insurance company is going to continue to pay the remaining 2 years to your estate. But if you live, say, 20 years, the insurance company will take the risk and pay the monthly amount for life. The second type of annuity is simply a guaranteed income annuity for a fixed number of years without taking life expectancy into account. So if you call up your friendly neighborhood insurance company and ask them for a quote, how do you know if you're getting a good deal? This is where the ability to perform basic financial math is vitally important. What we're talking about is the ability to move seamlessly between the present value of a lump sum of money and the future value of an income stream. And the most important variable in this instance is what's called the discount rate. It's essentially equivalent to the interest rate that's being charged for that money in the future. Now let's be clear. The calculations to perform this math are pretty extensive if you're doing it longhand on a piece of paper. Unfortunately, spreadsheet programs like Excel have a function embedded in them that makes the math pretty quick and easy. But before you can use the function, you need to understand the concept. And what I've discovered is that a lot of people, and I'm talking people with university degrees, many of them don't even understand the concept. When you hear guys like Robert Kiyosaki preaching from the mountaintops about the importance of financial literacy, this is what he's talking about, and he's absolutely right. I'm going to give you a quote that I received from a large insurance company. For an investment of $100,000, the insurance company will guarantee you $893 a month for 10 years. Now, if you multiply $893 a month times 120 months for 10 years, that comes to a total of $107,160. So in 10 years, they're giving you an extra $7,160 for the benefit of holding on to that $100,000 for the length of that time. Now, if you kept your money in your bank account and earned zero interest, simply withdrawing the same $893 a month, the money would run out after 9.3 years instead of 10. It seems like the insurance company is giving you a little bit extra, but not very much. How do you determine how much they're giving you? It's not simple math. As I said before, the Excel and the favorite spreadsheets all have a function that's useful in determining the value of the offer from the insurance company. The function that we're going to use is the rate function. The rate function takes in 4 inputs: the number of periods, in this case 120 months, the payment, $893, the lump sum at the beginning, that is $100,000, and the lump sum at the end, which is 0. And from that, it's going to give you an interest rate. Now, the interest rate it returns is per month, so we're going to multiply that result by 12 in order to get the annual interest rate. You plug these numbers into Excel, and you're going to essentially find that the insurance company is essentially offering you a 1.4% growth on your money. Is 1.4% a good number? Well, I guess it depends. Is it good compared to what? Compared to the 10-year U.S. Treasury yield of 1.549%, the U.S. Treasury is actually a little bit better, but not by much. The same money invested in 10-year Treasuries would give you $900 a month instead of $893 from the insurance company. And generally speaking, U.S. Treasuries are considered among the most conservative and safest investments. Since the U.S. Federal Reserve actually prints the money, it's hard to get much safer than that if you're denominated in U.S. dollars. On the other hand, if you're in the business of lending money secured on real estate at a conservative ratio of no more than, say, 60 or 65% loan to value, you can often command rates in the open market of 6% or more. And if you were to invest the money at 6%, Instead of handing it over to an insurance company or investing in treasury bills, you'd earn a monthly income of $1,110 on that same $100,000 investment. Clearly, that's a lot better. But here's the sad thing. There are lots of people out there handing their money over to an insurance company to guarantee them an income for life. Many of them don't have much money to begin with, and the lack of education on how to perform the simple math is ultimately going to cost them even more money. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.